Warren Buffett once said, $148 billion. That's what patient, disciplined value investing created over 60 years. Not through luck, not through market timing, not through chasing hot stocks or the latest trends. Through a simple strategy executed with unwavering discipline for 6 decades. On December 31st, 2025, Warren Buffett stepped down as CEO of Berkshire Hathaway after transforming a failing textile company into one of the most successful investment vehicles in history. His Berkshire Hathaway Class A shares returned over 5,500,000% since 1965. That's not a typo. 5.5 million percent. The S&P 500? 10.4% annually over the same period. Buffett, 19.9% annually, year after year, decade after decade. Today, I'm going to break down the complete Warren Buffett investment strategy, the exact principles he used to build this fortune, the value investing framework, the dividend strategy that generates over $5 billion annually for Berkshire, the actual portfolio he left in the hands of his successor, Greg Abel, and most importantly, how you can apply these same principles starting today. This isn't theory. This is the documented, verified strategy of the greatest investor in history. If you believe this information is important, consider sharing this with those you believe value their financial peace of mind as much as you do. Before we dive into specific techniques, you need to understand the 3 foundational pillars that made everything else possible. These aren't just investment tactics. They're the philosophical bedrock of Buffett's entire approach. Pillar 1, value investing. The first pillar is value investing, but not the way most people understand it. Value investing doesn't mean buying cheap stocks. It means buying wonderful businesses at prices significantly below their intrinsic value. Buffett learned this from his mentor, Benjamin Graham, at Columbia Business School, but he refined it with the help of Charlie Munger, who convinced him to shift from cigar butt investing, buying terrible businesses at rock-bottom prices, to buying excellent businesses at fair prices. The core principle: a business has an intrinsic value based on the cash it will generate over its lifetime. Your job as an investor is to calculate that value, then wait patiently until the market offers you that business at a significant discount to what it's actually worth. Not 10% off, not 15% off. Buffett wants a margin of safety of at least 25 to 30%. He wants to buy $1 of value for 65 to 75 cents. Why? Because even the best analysis can be wrong. Economic conditions change. Management makes mistakes. A large margin of safety protects you when your assumptions don't play out perfectly. Pillar 2, long-term investing. The second pillar is long-term investing, and when Buffett says long-term, he means it literally. Our favorite holding period is forever. That's not marketing language. That's his actual strategy. Look at Berkshire's portfolio. Coca-Cola purchased in 1988, still holding. American Express purchased in 1991, still holding. These positions have been held for 37 and 35 years respectively. Why does this matter so much? First, it eliminates transaction costs. Every time you sell and buy something else, you pay commissions and spreads, small amounts that compound into massive wealth destruction over decades. Second, it defers taxes. When you sell a winner, you trigger capital gains taxes. That's money that could have kept compounding, but instead goes to the government. By holding forever, Buffett lets his winners compound tax-deferred indefinitely. Third, and most important, it lets the underlying business do what great businesses do, grow their intrinsic value over time. Great companies expand, they innovate, they increase earnings, they raise dividends, but you only benefit from all of that if you hold. The stock market is designed to transfer money from the impatient to the patient. Buffett chose patience. Pillar 3, quality over quantity. The third pillar contradicts everything traditional financial advisors teach. It's concentration, not diversification. Buffett's Berkshire Hathaway portfolio holds 46 stocks. But here's the shocking part. The top 5 holdings account for approximately 70% of the entire equity portfolio. Apple, American Express, Bank of America, Coca-Cola, and Chevron. 5 companies, 70% of the portfolio. Traditional portfolio theory says that's insane. Too much risk, not enough diversification. Buffett disagrees completely. Diversification is protection against ignorance. It makes little sense if you know what you are doing. His argument is simple. Why would you put your 43rd best idea on equal footing with your best idea? If you've done your homework and found a truly wonderful business at a great price, put meaningful capital into it. Of course, this requires deep knowledge. You can't concentrate unless you truly understand what you own. But if you do understand it, if you've studied the business model, the competitive advantages, the management, the financials, then concentration amplifies returns. Why they work together. These 3 pillars work together synergistically. Value investing identifies wonderful businesses at discounted prices. Long-term holding lets those businesses compound their intrinsic value while deferring taxes. Concentration ensures your best ideas have maximum impact on your wealth. Remove any one pillar and the strategy falls apart. Chase expensive stocks and your margin of safety disappears. Trade frequently and taxes destroy your compounding. Over-diversify and mediocre ideas dilute your winners. Together, these 3 principles created one of the greatest fortunes in history. Now let's go deeper into value investing. How do you actually identify wonderful businesses trading below their intrinsic value? Buffett uses 5 specific criteria. Think of these as 5 filters. Every investment must pass through all 5. If it fails even one, he walks away. Criterion 1. Intrinsic value. Intrinsic value is the present value of all future cash flows a business will generate, discounted back to today. That sounds complicated, but the concept is simple. A business is worth the cash it will produce over its lifetime, adjusted for the time value of money. Buffett doesn't use complex formulas. He estimates conservatively. He asks, how much cash will this business generate next year? The year after? Can it sustain that for 10 years? 20 years? For example, Coca-Cola sells beverages in every country except Cuba, North Korea, and Russia. They have over 24 billion-dollar brands. They've been growing for 139 years. Buffett can confidently predict they'll still be selling Coca-Cola in 2026, 2036, 2046. That predictability lets him estimate intrinsic value with confidence. Compare that to a hot tech startup. No earnings, burning cash, uncertain business model. Impossible to predict cash flows 5 years out, let alone 20. Buffett only invests when he can estimate intrinsic value with reasonable accuracy. Criterion 2. Margin of safety. Once Buffett calculates intrinsic value, he doesn't buy at that price. He waits for a significant discount. If he believes a business is worth $100 per share, he waits until the market offers it for $65 to $75, 25 to 35% discount minimum. Why so large? Because he might be wrong. His assumptions about future growth could be too optimistic. The industry could change. A competitor could disrupt the business model. Management could make strategic errors. A large margin of safety protects against these errors. If the business is worth $100 and you pay $65, it can decline 15 to 20% in value and you still don't lose money. This is why Buffett often holds large cash positions. Berkshire held $381 billion in cash at the end of September 2025, not because Buffett couldn't find anything to buy, but because he couldn't find anything trading at a sufficient discount to intrinsic value. He's willing to wait years for the right price. Patience is part of the margin of safety. Criterion 3. Circle of competence. The third filter is brutal in its simplicity. Only invest in businesses you understand. Buffett avoided technology stocks for decades, not because tech is bad, but because he didn't understand the industry well enough to predict which companies would dominate long term. Then he invested in Apple. Why? Because by 2016, Apple had transformed from a technology company into a consumer brand company. The iPhone became a status symbol. People weren't buying chips and screens. They were buying into an ecosystem. That, Buffett understood, brand loyalty, switching costs, recurring revenue from services. He could analyze Apple the same way he analyzed Coca-Cola. Your circle of competence is different from Buffett's. Maybe you work in healthcare and understand pharmaceutical companies deeply. Maybe you work in retail and understand consumer behavior. Maybe you're an engineer who understands manufacturing. Whatever it is, invest there. Stay inside your circle. The size of the circle doesn't matter. Knowing its boundaries does. Criterion 4. Economic moat. The fourth criterion is an economic moat, a sustainable competitive advantage that prevents competitors from stealing market share. Buffett looks for several types of moats: brand power, Coca-Cola, Apple, American Express. These brands command premium pricing and customer loyalty that generic competitors can't replicate. Network effects. American Express becomes more valuable to merchants as more consumers carry the card, and more valuable to consumers as more merchants accept it. Cost advantages. BNSF Railway owns thousands of miles of track. A competitor can't replicate that infrastructure. Berkshire Hathaway Energy owns transmission lines, power plants, pipelines, huge capital investments that create barriers to entry. Switching costs. Once a business integrates certain software or systems, switching to a competitor is painful and expensive. This creates customer stickiness. Regulatory barriers. Insurance and utilities operate in heavily regulated industries. Licenses and approvals create moats. Without a moat, competition erodes profits. A business might be cheap today, but if anyone can copy it, margins compress and intrinsic value declines. Buffett only invests in businesses with wide, durable moats. Criterion 5. Quality management. The fifth criterion is quality management. Specifically, managers who think like owners, allocate capital intelligently, and operate with integrity. Buffett looks for managers who allocate capital rationally. Do they invest in high-return projects? Do they return cash to shareholders when they can't find good investments? Or do they waste money on empire-building acquisitions and vanity projects? Communicate honestly. Do they share bad news transparently? Do they admit mistakes? Or do they spin everything positively and blame external factors? Treat shareholders as partners. Do they act as stewards of your capital? Or do they enrich themselves with excessive compensation and perks? Buffett famously said he looks for managers with integrity, intelligence, and energy. If they don't have the first, the other two will kill you. He's serious. He's walked away from excellent businesses with poor management. Why these 5 filters eliminate bad investments? These 5 criteria work as elimination filters. Most stocks fail the intrinsic value test. They're too unpredictable to value. Of those that remain, most trade at or above fair value, failing the margin of safety test. Of the discounted stocks, most are outside your circle of competence. Of those you understand, most lack durable competitive advantages, and of the moated businesses, many have mediocre or dishonest management. By the time a stock passes all 5 filters, you're left with a tiny fraction of the market. But those are the businesses worth owning. Quality over quantity, always. Now let's talk about dividends. Because Berkshire Hathaway itself doesn't pay a dividend, many people don't realize that dividend income is absolutely central to Buffett's strategy. In fiscal year 2024, Berkshire Hathaway received $5.2 billion in dividend income from its equity holdings. $5.2 billion every single year without selling a single share. Let me repeat that. Berkshire collected over $5 billion in cash just from owning stocks that pay dividends. But here's what most investors miss. Buffett doesn't chase high yields. He chases dividend growth. The difference: high yields versus dividend growth. The highest yielding stocks in the market often signal danger. 7, 8, 9% yields usually mean the market expects a dividend cut. The business is struggling. The payout is unsustainable. Buffett avoids those completely. Instead, he focuses on companies with modest current yields but long histories of consistent dividend increases. Companies that raise their dividends every single year for decades. Why? Because of a concept called yield on cost. When Buffett bought Coca-Cola in 1988, the dividend yield was modest, maybe 2 to 3% on his purchase price. Nothing special. But Coca-Cola has raised its dividend every single year for 63 consecutive years. 63 years without a single cut or freeze. Today, Berkshire receives $816 million annually in dividends from Coca-Cola. The original investment was $1.3 billion. Do the math. 816 million divided by 1.3 billion equals a 63% annual yield on the original cost basis. 63% every year in cash, tax advantaged, without selling a single share. That's the power of dividend growth investing. The 4 criteria for dividend stocks. So how does Buffett identify great dividend growth stocks? 4 specific criteria. Criterion 1. Long dividend history. First, a long dividend history. Buffett wants to see at least 10 years of uninterrupted payments, ideally 25 years or more. Why? Because a long dividend history proves the business generates consistent cash flow through multiple economic cycles, through recessions, through industry disruptions, through management changes. Coca-Cola has paid dividends since 1920. 106 years without missing a payment. That's not luck. That's a fortress business model. Companies with long dividend histories are called dividend aristocrats, 25-plus years of consecutive increases, and dividend kings, 50-plus years. These companies have proven they can sustain and grow dividends through anything the economy throws at them. Criterion 2, consistent growth. Second, consistent growth. Not just paying dividends, but increasing them every year. Coca-Cola, 63 consecutive years of increases. Johnson & Johnson, 62 consecutive years. Procter & Gamble, 68 consecutive years. American Express, steady increases since Berkshire's investment. This consistent growth is crucial. A frozen dividend loses value to inflation. A growing dividend compounds your income. Let's say you invest $10,000 in a stock yielding 3%. That's $300 in year 1. If the dividend freezes, you get $300 every year. After 30 years, you've collected $9,000 in dividends. Nice. But if the dividend grows 7% annually, a realistic rate for quality dividend aristocrats, your income compounds. Year 10, you're receiving $590. Year 20, $1,161. Year 30, $2,285. After 30 years, you've collected $34,500 in total dividends, almost 4 times more than the frozen dividend. Same initial investment, dramatically different outcome. Criterion 3, sustainable payout ratio. Third, a sustainable payout ratio. This is the percentage of earnings paid out as dividends. Buffett wants to see payout ratios below 60%. Why? Because companies need to retain some earnings to reinvest in growth, pay down debt, weather downturns, and increase future dividends. If a company pays out 100% of earnings, there's nothing left for these purposes. The dividend is at risk. Any earnings decline forces a cut, but at 50 to 60%, the company has cushion. Earnings can decline 20 to 30%, and the dividend is still safe. Management can keep investing in growth, and there's room to increase dividends faster than earnings grow. American Express has a payout ratio around 25%. incredibly safe, lots of room for growth. Criterion 4, strong fundamentals. Fourth, strong fundamentals, specifically high return on equity and manageable debt levels. Return on equity measures how efficiently a company generates profit from shareholder capital. Buffett looks for ROE above 15%, ideally above 20%. Coca-Cola, American Express, Apple. These companies consistently generate returns on equity of 25 to 40%. They turn every dollar of shareholder capital into substantial profits. Debt matters too. High debt loads are dangerous during recessions. Interest payments consume cash that should go to dividends. Buffett prefers companies with low debt-to-equity ratios. They have financial flexibility. They can maintain dividends during downturns. They can invest opportunistically when competitors struggle. Real examples from Buffett's portfolio. Let's look at real examples from Berkshire's actual portfolio as of September 30th, 2025. Coca-Cola. Berkshire owns 400 million shares of Coca-Cola. Original investment, $1.3 billion in 1988 through 94. Current annual dividend income, $816 million. Yield on cost, 63%. Position held, 37 years and counting. Coca-Cola has increased its dividend for 63 consecutive years. It operates in every country except Cuba, North Korea, and Russia. It has over 24 billion-dollar brands, predictable, stable, growing. This is the textbook example of dividend growth investing. American Express Berkshire owns 151.6 million shares of American Express, held since 1991. Current annual dividend income, approximately $424 million. American Express has a low payout ratio, strong ROE, and operates a closed-loop payment system that generates fees from both merchants and cardholders. Buffett considers it a forever holding. Bank of America. Berkshire owns 605.3 million shares of Bank of America. Current annual dividend income, approximately $992 million. This is Berkshire's largest dividend payer by total income. Bank of America benefits enormously from rising interest rates, has a strong retail banking franchise, and maintains conservative underwriting standards. Buffett sold some shares in 2024 and 2025 but still holds a massive position. The power of dividend growth investing. Here's what makes dividend growth investing so powerful. 1. It provides increasing income without selling shares. Your principal stays invested in compounding while cash flows to you. 2. Dividend increases signal management confidence. Companies don't raise dividends unless they're confident about future cash flows. 3. Dividends are tax advantaged. Qualified dividends are taxed at lower rates than ordinary income. 4. Dividends smooth volatility. Even if the stock price fluctuates, you're collecting cash every quarter. 5. Dividend growth compounds wealth. Rising dividends support rising stock prices. You benefit from both income and appreciation. This is why Berkshire collects over $5 billion annually. This is why Buffett will never sell Coca-Cola or American Express. The dividend income alone justifies holding forever. Now let's analyze the actual portfolio Warren Buffett left in the hands of his successor, Greg Abel, when he stepped down as CEO on December 31st, 2025. The most recent filing we have is from September 30th, 2025. Berkshire's equity portfolio was valued at $267 billion, 46 total holdings. But remember, concentration, not diversification. The top 10 holdings. Here are the top 10 holdings with their exact percentages of the portfolio. Number 1, Apple, 22.69% of the portfolio. Berkshire owns 238.2 million shares valued at approximately $60 billion. Apple is a fascinating case. Buffett avoided technology for decades, then made Apple his largest position ever. Why? Because Apple evolved from a tech company into a consumer brand company. The iPhone created an ecosystem with massive switching costs. Apple's services business, subscriptions, App Store, iCloud, generates recurring revenue with high margins. Buffett sold approximately 61.8 million shares during 2025, reducing the position from over 40% of the portfolio to around 22%. But Apple remains his highest conviction holding. Number 2. American Express 18.84% of the portfolio. Berkshire owns 151.6 million shares, held continuously since 1991. American Express operates a closed-loop payment network. It's both the processor and the lender. This allows it to profit from both sides: merchant fees and cardholder interest and annual fees. Amex targets affluent customers who spend more and are less sensitive to economic downturns. Average spending per card is significantly higher than competitors. Buffett calls this a forever holding. Number 3. Bank of America, 10.96% of the portfolio. Berkshire owns 605.3 million shares, down from over 1 billion shares in mid-2024. Bank of America is highly sensitive to interest rates. When rates rise, net interest income expands dramatically. No money center bank benefits more from rate changes than BofA. Despite selling roughly 40% of the position, Buffett still considers it a core holding. Number 4. Coca-Cola, 9.92% of the portfolio. Berkshire owns 400 million shares, held since 1988. We've already discussed Coca-Cola extensively. 63 consecutive years of dividend increases, 9.3% ownership of the entire company, generates $816 million annually in dividends. This will never be sold. Number 5. Chevron, 7.09% of the portfolio. Berkshire owns 118.6 million shares. Chevron provides exposure to energy with less volatility than pure upstream drillers. It operates across the entire value chain: exploration, production, refining, chemicals, retail. Chevron has raised its dividend for 37 consecutive years and offers a 4.57% yield. It provides portfolio diversification and income. Number 6. Occidental Petroleum, approximately 4 to 5% of the portfolio. Berkshire owns 264 million shares of common stock plus $8.49 billion in preferred stock yielding 8%. Occidental is more exposed to oil prices than Chevron, giving Buffett leveraged exposure to crude. Total dividend income from Occidental, over $900 million annually between common and preferred dividends. Number 7. Chubb, approximately 3.3% of the portfolio. Berkshire owns approximately 66 million shares of the property and casualty insurer. This was a relatively recent addition, initiated in Q1 2024. Buffett knows insurance better than almost any business. Chubb has excellent underwriting discipline and serves high-value clients. Number 8. Kraft Heinz, approximately 3% of the portfolio. Berkshire owns 325.6 million shares. This investment has been disappointing. The stock has underperformed since the merger, but it generates steady dividends and has iconic brands. Buffett likely holds for the dividend income and tax reasons. Number 9. Moody's, approximately 2.5% of the portfolio. Berkshire owns 24.7 million shares. Moody's is one of 3 major credit rating agencies. It operates in an oligopoly with high barriers to entry and generates excellent margins. The yield on cost is approximately 37%. Number 10. Alphabet, approximately 1.6% of the portfolio. Berkshire owns approximately 17.8 million shares valued at $4.3 billion. This is a new position, initiated in Q3 2025. Alphabet was beaten down and Buffett saw value. It's a relatively small position, but signals openness to quality tech companies at the right price. What they all have in common. Look at the common threads. Strong brands: Apple, Coca-Cola, American Express, Chevron. These are household names with pricing power. Predictable cash flows. Every single one generates consistent profits year after year. Competitive moats, network effects, brand loyalty, regulatory barriers, scale advantages. Quality management. Each company is led by capable executives who allocate capital well. Dividend payers: 9 of the top 10 pay dividends. Only Alphabet doesn't. Long-term holdings. Most have been held for decades. Why concentrate 80% in 10 stocks? The top 10 holdings represent approximately 86.7% of the entire portfolio. This is deliberate. Buffett believes in putting significant capital into his best ideas. If you've done the work to find a wonderful business at a fair price, why dilute it with mediocre ideas? This concentration requires conviction. You must truly understand what you own. But if you do, the rewards are substantial. Lessons from the current portfolio. 3 key lessons. 1. Quality beats quantity. 10 great businesses beat 50 mediocre ones. 2. Hold forever. These positions have compounded for decades because Buffett didn't sell. 3. Dividends matter. The portfolio generates over $5 billion annually in passive income. Now let's talk about you. How do you actually apply Buffett's strategy starting today? Here's the step-by-step framework. Step 1. Define your circle of competence. First, identify what you truly understand. Write down your professional experience. What industries do you work in? What products do you use daily? What business models do you understand deeply? Be honest. Your circle doesn't need to be large. It needs to be clearly defined. If you work in healthcare, you might understand pharmaceutical companies, medical device makers, hospital operators. If you work in technology, you might understand software as a service, cloud computing, cybersecurity. If you work in retail, you might understand consumer brands, e-commerce, supply chain management. Start there. Don't invest outside your circle just because something looks cheap. Step 2. Identify quality businesses. Within your circle of competence, identify quality businesses using Buffett's criteria. Do they have economic moats, brand power, network effects, cost advantages, switching costs, regulatory barriers? Do they generate high returns on equity, above 15%, ideally above 20%? Do they have low debt relative to equity? Do they have honest, capable management? Do they operate in industries with favorable long-term trends? Create a watch list of 10 to 20 companies that meet these standards. Step 3. Calculate intrinsic value for each company on your watch list. Estimate intrinsic value. You don't need a PhD in finance. Use simplified methods. Discounted cash flow. Estimate future cash flows and discount them to present value. Earnings multiple. Compare to historical PE ratios and industry averages. Dividend discount model. Value based on future dividend payments. The goal isn't precision, it's a reasonable range. Is this business worth $80 to $100 per share or $120 to $150? Conservative estimates are better than optimistic ones. Step 4. Wait for margin of safety. Here's where discipline matters most. Even if you found a wonderful business, don't buy at full price. Wait for a 25 to 35% discount to your estimated intrinsic value. If you calculate a business is worth $100 per share, set an alert for $65 to $70. Then wait. This might take months, it might take years. Buffett held cash for years during the 2013 to 2020 period because valuations were too high. He was willing to wait. You must be too. Step 5. Buy with long-term mindset. When you finally buy, commit to holding for at least 5 to 10 years. This is crucial. Short-term volatility is guaranteed. The stock might drop 20% next month, or 50% during a recession. If you're not prepared to hold through that volatility, you'll sell at the bottom and lock in losses. But if you've bought a wonderful business at a significant discount, temporary price declines are opportunities to buy more, not reasons to sell. Step 6. Reinvest dividends. If the company pays dividends, reinvest them automatically. Most brokers offer dividend reinvestment plans for free. Enable them. This accelerates compounding dramatically. The dividends buy more shares. Those shares generate more dividends, which buy more shares. Over 30 years, dividend reinvestment can double or triple your total returns. Step 7. Quarterly review without reaction. Check your portfolio quarterly when companies report earnings. But don't react to short-term results. One bad quarter doesn't invalidate the investment thesis. Ask yourself, has the competitive moat weakened? Has management changed and deteriorated? Has the industry structure shifted permanently against this business? If the answer is no, do nothing. Let it compound. If the answer is yes, consider selling. But this should be rare if you bought quality. The alternative for beginners: index funds. Now here's Buffett's advice for most investors: don't try to pick individual stocks. Buy low-cost S&P 500 index funds. Buffett has said repeatedly that he recommends this for 90% of investors. Even in his will, he instructed that 90% of his estate be invested in S&P 500 index funds. Why? Because most people don't have the time, knowledge, or temperament to analyze businesses deeply. They'll make emotional decisions. They'll chase performance. They'll sell during crashes. An S&P 500 index fund gives you instant diversification across 500 quality businesses. It costs almost nothing in fees, and it has beaten most active managers over long periods. If you're not willing to do the deep work of value investing, don't try. Just buy index funds regularly, reinvest dividends, and hold for decades. You'll beat most professional investors. Before we finish, let's talk about the mistakes that destroy returns. Even if you understand Buffett's strategy, these errors can sabotage everything. Mistake 1: trying to time the market. The biggest mistake is trying to time market tops and bottoms. People wait for corrections to invest. Then when corrections happen, they panic and don't buy, or they buy, then sell when volatility continues. Market timing doesn't work. Studies show that being out of the market for just the 10 best days over 30 years cuts your returns in half. Buffett's approach: buy when you find value. Hold regardless of market conditions. Don't try to predict what the market will do next month. How to avoid it? Use dollar cost averaging if you're nervous. Invest a fixed amount monthly, regardless of price. This smooths your entry and removes emotion. Mistake 2: chasing high yields without sustainability. The second mistake is chasing high dividend yields without checking sustainability. A stock yielding 8 or 9% looks attractive, but often high yields signal danger. The market expects a dividend cut. The payout ratio is over 100%. The business is declining. Then the dividend gets cut and the stock crashes. You lose on both the income and the principal. How to avoid it? Check the payout ratio. Is it below 60%? Check the dividend history. Has it been raised consistently? Check free cash flow. Does the business generate enough cash to sustain the dividend? If any answer is no, avoid it regardless of yield. Mistake 3: selling winners too early. The third mistake is selling winners too early. You buy a stock at $50, it goes to 70, 40% gain. You sell and feel smart. Then it goes to 100, 150, 200. You left enormous gains on the table. Buffett held Coca-Cola through multiple periods where it doubled. He never sold. The position is now worth 25 times his original investment. How to avoid it? Before buying, decide under what conditions you would sell. Only sell if the business fundamentally deteriorates or becomes wildly overvalued. Otherwise, hold forever. Mistake 4: investing outside your competence. The fourth mistake is investing outside your circle of competence. A stock is getting hyped. Everyone's talking about it. FOMO kicks in. You buy without understanding the business model, the competitive landscape, or the financials. When it drops 30%, you panic and sell because you never had conviction. You don't understand if the drop is temporary or permanent. How to avoid it? Simple rule. If you can't explain the business model to a 12-year-old, don't invest. Stay within what you understand. Mistake. 5. Ignoring fees and taxes. The fifth mistake is ignoring fees and taxes. Trading costs, management fees, and taxes compound over decades. A 2% annual fee might not sound like much, but over 30 years it can reduce your ending wealth by 40 to 50%. How to avoid it? Use low-cost index funds. If you buy individual stocks, hold them in tax-advantaged accounts when possible. Trade as little as possible to defer taxes. These 5 mistakes have destroyed more wealth than market crashes. Avoid them. So there you have it. The complete Warren Buffett investment strategy. Let me summarize the 5 key principles. 1. Value investing. Buy wonderful businesses at significant discounts to intrinsic value. Demand a margin of safety of 25 to 35%. 2. Quality over quantity. Concentrate your portfolio in your best ideas. 10 great businesses beat 50 mediocre ones. 3. Economic moats. Only invest in businesses with durable competitive advantages that protect them from competition. 4. Dividend growth. Focus on companies that consistently raise dividends, not just high current yields. Let yield on cost compound over decades. 5. Hold forever. Let great businesses compound for years or decades. Minimize taxes and trading costs. Let time work its magic. This strategy created a 5,500,000% return over 60 years, $148 billion in wealth. It's not complicated, but it requires discipline, patience, and a long-term mindset that most investors simply don't have. The question is, do you? If you find value in this, consider sharing it with those you believe need it. And most importantly, discuss these 5 principles with your family. The best financial decisions are born from the conversations we have with those we trust. Now go make it happen.